I loved your summary, Vitor. You went right to the heart of it, which is when private is on its back in a pandemic, it is public investment to the rescue. Why is this so difficult? Why is it so hard to commit public investment in democracies?
Uh, Thanks for having me, Tom. We do make a very strong case for public investment in the fiscal monitor. We argue that in moments of extreme uncertainty like that, which is caused by COVID-19, public investment allows for a bridge over the uncertainty and provides the private sector with opportunities for profitable investment. Specifically, we estimate that multipliers are elevated under the circumstances of 1% of GDP expansion in public investment in advanced and emerging market economies would lead to an increase in GDP of 2.7%, because it would motivate private investment to increase by 10%. And more importantly, private and public investment would lead to employment creation of between 20 and 33 million
Yeah.
jobs, according to our estimates. Public investment is always difficult, Tom, because the payoff normally comes later. It's only when public investment affects potential output that
Right.
the benefits come to fruition. And that takes time, and the political systems around the world are not patient.
I want to, in the time that we've got left, Dr. Gaspar, talk about the little g. There is a great assumption in our crisis with the expansion of fiscal deficits, the expansion of trade deficits in selected countries, that we will, quote unquote, grow our way out of this. How do you respond to that maxim?
So we do have, for the first time since the start of COVID-19, we have medium-term projections, so we can actually answer your question. We do see some permanent scarring in terms of the level of output, but not in terms of the growth rate. So basically, there's a permanent loss, but the growth rate regains. That is crucial for the public debt to GDP ratio going
Mm-hmm.
forward. We see this jump up in 2020. Uh, Public debt goes from 83% of GDP in 2019 to 98.7
Wow.
at world
Wow.
level. It's a very strong jump up. But wait, Tom, countries like the US or the UK, the jump up is even greater at more than 20% of GDP. But going forward, very low interest rates for long and the rebound in economic activity means that the contribution of the interest payments and growth actually helps public debt coming down. And there is also a correction in our baseline of the
Mm-hmm.
primary deficit. So the primary deficit comes down, and the debt level at world level stabilizes at around
Right.
100% of GDP.
If I could fold one final question into what we've observed this morning in Europe, which is a real reaffirmation of disinflationary tendencies. Vitor Gaspar, on the experiment of negative interest rates, how has that worked?
Look, central banks have for many years developed monetary policy strategies based on a monetary transmission mechanism that relies on interest rates. Now, when inflation is very low, when interest rates are very low, there are constraints on the traditional monetary transmission mechanism. That does bring additional uncertainty. We have less knowledge about the transmission mechanism under those circumstances, and that's one of the reasons why central banks around the world are conducting monetary policy
Mm-hmm.
strategy reviews.